Thank you for joining us.
My pleasure.
It's great to talk to you. So you and I spoke right after you became governor of the Fed. That was like a month ago or so. How's it going?
It's going well. You know, it's a collegial group of people. It's a great group of people. We are having ongoing economic and policy debates, which I'm participating in, and I think there's a lot of exciting work to do.
So we're in this period right now where the market is worried about the U.S.-China trade relationship. Looks like some hostilities are building again. How do you think that's impacting the economy?
Well, I think it's too early to say whether it's impacting the economy now. However, I do think it is potentially an important change to the outlook. And so, yes, the labor market continued to weaken in the first half of this year. I think that part of that was due to uncertainty over policy. We might have had the biggest tax hike in history, and so maybe there were firms holding off on investing until the tax bill was done. And we also had the biggest rearrangement to global trading policy in half a century. And so while those deals were being negotiated and people were waiting to see where tariff rates would shake out, it wouldn't be surprising to me if they held off on making some decisions. So I do think that uncertainty is a potentially helps explain some of the weakness we saw in the first half of the year. And then really until last week, I'd been operating under the assumption that a lot of that uncertainty had dissipated. The tax bill had become law, and trade deals had been made for most of our large trading partners. And then, last week, China decided that the deals that had been made earlier in the year in Geneva, London, and Madrid no longer bound them. And so I had been operating under the assumption that the uncertainty had dissipated, and that therefore I felt more sanguine about some aspects of the growth outlook. And now potentially this is back because the Chinese are reneging on deals that were earlier made. And so I think it's incumbent upon us as policymakers to think about the introduction of a new tail risk. And the tail, the left tail has become a little fatter, as we might say. And we have to recognize that, there potentially is some difference now versus where we thought things were a week ago. And therefore adjust policymaking.
Downside risks to growth.
There's now more downside risks than there was a week ago, and I think it's incumbent upon us as policymakers to recognize that should get reflected in policy.
Isn't it a little early to conclude that?
Oh yeah, it is early to conclude that things are actually changing, right? But it's about where the balance of risks has moved, right? And risks exist now that didn't exist a week ago, that didn't exist a month ago.
I mean, you wanted much lower rates a week and a month ago. So do you want even lower rates now?
No, I wouldn't say that I want even lower rates now than I did a week or a month ago. However, with the change to the balance of risks, I think it becomes even more urgent that we get to a more neutral place in policy quickly, as opposed to sort of waiting for downside, as opposed to waiting for downside data to materialize. To the extent that I think that policy is quite restrictive right now, that sets us up to be vulnerable to shocks. And if you hit the economy with a shock when policy is very restrictive, the economy will react differently than it would as if policy was not as restrictive. And so I think it's even more important now than I did a week ago that we move quickly to a more neutral stance.
But, I mean, you were in the meeting for 2 days, and you heard the deliberation of your colleagues. Most of them don't seem to feel the same way you do. Is that right? Is that accurate to characterize?
I think that's right, and I think that it's fair to characterize my view as in some ways out of consensus. I have no problem disagreeing with people when I come to a conclusion based on analysis of data, based on analysis of economic models, and then I give my view. And I have no problem giving that view if it differs from the views of other people, whether they're my colleagues or not. And so I don't think it's unfair to sort of describe my view as out of that consensus in some ways, but I think in other ways it's very inside consensus. If you look at, sort of the what people call the dots, right, the sum of economic projections, the only real material divergence between me and I think the rest of the committee is on how quickly we get to neutral, right? And so I wanted to get to neutral relatively quickly. I think a lot of other people have us getting to neutral also, but just maybe a little bit more slowly. And part of that difference, right, on the fact that I want to get there more quickly than others is because I'm less concerned about upside inflation in the near future, which then gives us the flexibility and the freedom to get there, I think more quickly.
What is neutral? And how do you know what that level should be?
Yeah, so that's a great question. I think we have to acknowledge that these models, so you can't observe neutral, right? The neutral policy rate is the rate at which monetary policy is neither restrictive nor accommodatory. It's you're not slamming the gas, you're not slamming the brakes, you're sort of just coasting along. And if you're below neutral, you're stimulating the economy. If you're above neutral, you're restricting the economy, you're holding it back. And I think it's important for us to understand that the models that estimate neutral tend to give us wide confidence bands. So there is some difficulty in knowing exactly where neutral is at any moment in time. However, I think it's a little bit easier to think about arguing from changes to neutral. And we know that there are some economic factors that push neutral higher, and we know that there are some economic factors that push neutral lower. And so recognizing that there's uncertainty about exactly where neutral is at any moment in time, to me, doesn't mean that we can't argue, we can't reason about where it's moved recently. And in my mind, the economy has experienced some very substantial shocks in the last few years, the types of shocks that normally would have taken decades to unwind. And usually people will think that neutral moves only very slowly, that the neutral rate moves only very slowly, at a very glacial pace, because the things that drive neutral also move very slowly. And so think, for example, population growth, right? Countries with high population growth rates tend to have high interest rates, and countries with low population growth rates tend to have low interest rates, right? That's because population growth helps determine the neutral rate. Population growth is normally something that changes extremely slowly. Right? You get changing fertility rates due to cultural changes or due to changes in medical technology that make people get married later or have fewer children or not get married at all. And so as a result, population growth will decline very, very slowly over the course of decades. But due to the sharp changes in immigration policy, we experienced the largest population growth shocks in our lifetimes in both directions, upside and downside, in rapid succession. We experienced population growth shocks in 3 years that normally would have taken 30 to 40 years. And so, to me, while I think it's important to be humble about knowing exactly where neutral is at any moment in time, I think it's easier to say that we know some of the drivers of neutral, and we can sort of observe what happened to those drivers.
You said that you are still very restrictive on rates, which is also kind of a point for debate, because the economy is doing very well. So where do you see it being very restrictive?
Well, the economy was weaker in the first half of the year versus where it had been last year.
That was trade, wasn't it? Imports and exports, stocking up before the tariffs.
Well, it was potentially related to trade. It was related to trade, to some front running of tariffs. It was related to some uncertainty around trade and taxes, I mentioned before. But I do think other elements of core underlying domestic demand were weaker in the first half of the year than they had been in last year. Thus far, for the third quarter, we have very little data to give us indications for the third quarter. But I also think that the labor market has clearly weakened somewhat over the course of the year, and the unemployment rate has ticked up, has been moving up gradually in the recent past. So, I don't, and then you sort of look at something like the housing market, right? And housing is one of the biggest, if not the biggest transmission channel of monetary policy into the real economy. And that has been, I think rather moribund for a while now. On
high rates, mortgage rates.
Largely on high rates, yeah.
But if the Fed lowers rates, it's not guaranteed that mortgage rates will come down. We didn't see that last year.
So that's a great point. And so, last year, I thought that cutting was the wrong move, right? And it's related to this neutral rate conversation we were just having. So I thought last year the neutral rate was much higher due to a variety of factors, including things like population growth being higher, including things like deficits being wider, that raised the neutral rate. Which means that if neutral was here, so if keep policy here and neutral's up here, then I think that policy is not very restrictive. And so I thought that cutting last year wasn't necessarily the right move. If neutral has come down and you keep policy here, then the distance between them has grown. And so therefore policy became more restrictive, even though you kept the nominal rate relatively similar. And so that, in my mind, is reasons for cutting. And so that's why I thought last year it was a mistake to cut, and this year it's the right move to cut.
And the market told you that, and you think this year market will go along.
Exactly. So in the, I think, 18 trading sessions since we cut rates in September, long yields are, I think, like 4 or 5 basis points down. In the same 18 sessions after the Fed cut rates last September, they were up by approximately 30 basis points. And then they went starting from 30 to go all the way to about 110 basis points up.
So it's working.
So I think last year the bond market told you that cutting was a mistake, and I think that bears out that I was right. And this year, thus far, the bond market is not telling you. No, it may yet, right?
Sure.
But thus far, it's not telling us that we're wrong to
Well,
cut.
part of it is the uncertainty around the China trade stuff. And so now the market is fully pricing in 2 more cuts for the rest of this year. Aside from what you want to see, does that sound realistic?
Aside from what I want to see, yes,
Which is more.
that sounds realistic, and that's consistent with where the median projection from the committee was in the last summary of economic projections.
And I know it's early, but what are your expectations for how many cuts we'll get next year?
It's early. I think there's a lot less disagreement from myself versus the rest of the committee on next year than there was in this year. It's purely a speed thing. And, we'll have to see what the committee looks like at that point in time. We'll have to see how the data evolve.
What about the inflation numbers? Because you could say the Fed shouldn't be cutting right now because inflation's been firming up. And I know that the Treasury Secretary said it's not tariffs, it's not in goods, it's in services, but it's still moving closer to 3 than it is to 2, isn't it?
Well, so here's where I think you have to be, where monetary policy has to be forecast dependent and not data dependent. I think that the data can be quite backward looking. And so therefore it's incumbent, because monetary policy works with a lag. It doesn't hit, if you hike or cut interest rates today, it doesn't hit the economy tomorrow. It takes some time to get there. And people debate over how long these lags are. Everybody agrees they're long and variable. Most people think they're probably 12 to 18 months. But if that's the case, then you need to make policy today for where the economy is going to be 12 to 18 months or a year to 2 years from now, depending on how long you think the lags are. And if you make policy based on where prices were a year ago, you're just being very backward looking. And so you'll just continually be making policy based on, in my view, the wrong information. You want to be making policy based on where you think prices are going to be a year from now. And so when I look at a year, I see substantial disinflation coming from housing, coming from shelter inflation, which is the largest component of inflation. It's about 45% of core CPI and about half of that of core PCE. And I see a lot of disinflation coming from there for 2 primary reasons that I've emphasized.
Immigration.
Well, right. That's one of them. The other one is the catch-up effect. And so the way that shelter inflation is calculated is kind of wonky. So basically, if the market rent moves higher, so the price you see on Zillow, the price that you would actually lease an apartment for or a house for, that rent moves higher, but you don't reset your lease for 6 months, 8 months, a year, 2 years, however long your lease is, you don't experience the inflation until you reset your lease. And so and the way that the inflation is calculated is based on when you experience the inflation, not on what the current market rent that you'd see on Zillow is. And so if the market rent changes, there's a lag between when that market rent hits the lease reset, because you moved or you renewed your lease or whatever it is. And so that means that there's a substantial lag in measured inflation data versus market rents that you would see on the computer or if you signed a new lease immediately. Now, what matters is that lag means that measured inflation eventually catches up to market rents. Now, there had been a very substantial wedge in between the two of them, meaning there was a lot of catch-up to do. And while there was a lot of catch-up to do, the fact that market rents were relatively stable didn't mean that measured inflation would come down, because they were still catching up to the old inflation in rents. Right? Now that catch-up is done. When you look at the data, you look at new rents versus average rents, the catch-up is done. Means that the time at which measured shelter inflation catches down to where market rents is much closer now than it was a year or 2 or 3 years ago. It's much, much closer now. The other thing that I think drives shelter inflation is the immigration story.
Yeah.
When you change population growth in an economy, most people consume and produce, right? They work in the labor market and they also buy stuff from other people and companies. And so supply and demand doesn't really change that much for most product categories, for most markets when you adjust population up or down, because supply and demand will move by similar amounts. Housing is an exception because the housing supply is fixed.
Yeah.
Right? If you airdropped 10 million people into the country, you wouldn't instantly have 10 million new houses. You'd have 10 million new workers and consumers, but not 10 million new houses. If you took 10 million people out of the country and airdropped them somewhere else, you wouldn't magically have 10 million fewer houses. The supply is relatively fixed. And so there's a really strong feed-through into inflation from there.
But also, doesn't it put, on the flip side, upward pressure on wages when you have fewer immigrant workers?
I don't think so, because you have less demand also, right? And so is
that what we're seeing in the weaker jobs numbers, do you think?
Well, we certainly are not seeing material increases in wage inflation that would make you think that the labor market was going back into the type of imbalance that we saw after the pandemic, right? That we're definitely not seeing. So those predictions, I think, have thus far been rejected by the data. But I think that there's plenty of evidence that changes to population growth affect consumption, affect supply and demand by similar amounts. And so, yes, you have another worker, but that worker is also buying things in the economy. And so if they're buying things in the economy, the supply and demand are moving together, and you're not getting one outstripping the other.
So we were supposed to get an inflation report today. Didn't. Government shutdown. What do you think it would have shown?
Oh, well, that's above my pay grade.
How are you looking at alternative data sources? Like, how are you piecing together what's happening? You're going to have to make a decision at the end of October whether the government's open or not.
So I would love to have the data that we need to make the decision. We are fortunate that we only make monetary policy decisions outside of a crisis every 6 months. And so I'm still hopeful that we'll have more data by the time we get to the point.
6 weeks.
Yeah, sorry, every 6 weeks. Sorry,
yeah.
Thank you.
Yeah. That would be crazy.
Every 6 weeks, yes.
Yes.
So I'm hopeful that we have the data in hand by the time we get to the October FOMC meeting. However, there's a chance that we don't. And if we don't, then I would rely on what I said a moment ago, which is that policy should not be overly data dependent. It should be forecast dependent.
That's not how the Fed operates, though. I mean, how many times do we hear Fed Chair Powell say data dependent? I
mean, I think that you want to be data dependent if you either you don't have a forecast or you don't believe in your forecast, right? Or you don't have.
But if you look at the forecasts of the Fed in the dots, they project their economic and inflationary outlooks. They're mostly not right.
I think that is something that every forecaster should hold them, should hold themselves to account for when they're right or wrong, as I try and do, and change my mind when I get new information, as we did at the beginning of this conversation with
China.
rare earths.
Yeah.
And so I do think it is important to sort of have accountability for being right. But you want to be data dependent if you don't really have a forecast or you don't have a lot of confidence in your forecast. But if you have a lot of forecast and a lot of confidence in your forecast, then you don't really want to be as data dependent because that's so backward looking. And so for me, I have a forecast, and the data matter insofar as they would lead me to change my forecast. But if they're not leading me to change my forecast, then I would still act in accordance with my forecast. And of course, there's a chance that some of the data come in and make me say, "Hey, I was wrong. It looks like housing inflation is actually moving higher. That rents are moving, higher, and that therefore, there's rent disinflation that I'm relying on for shelter disinflation because shelter is such a big component of the measured inflation indices that's not happening." And then I would say, "Hey, my forecast might not be right. I need to change this, or I need to sort of rethink my policy outlook." Right now, I think that for something like that, there are some alternative data sources, right? Like, there are plenty of ways to observe market rents that would make me think. And if you saw a surge in market rents, I would say, hey, it's time to rethink my inflation thesis. Like, there's a serious question here. I'm not seeing anything that would make me seriously rethink the core elements of my forecast. I think I would be reading news articles about the housing market. I think I'd be reading news articles about the labor market. If there was widespread labor shortages or widespread layoffs or widespread, rent spikes or rent collapses or whatever, that would sort of make me think that my core forecast was really off. And so, it's really important that we get the data. Yeah. We need the data to make our forecasts. However, for the short run, if you are forecast dependent, then what matters to you, is there anything that would make you change your forecast?
When are we, okay, here's a forecast question. When are we going to get to 2% inflation?
So, to 2% headline measured PCE.
Headline PCE. That's Fed target, right?
Yeah, I think probably, let's say, a year and a half from now or so, if I remember correctly, where my dots were.
A year and a half from now.
Yeah, approximately.
And where does unemployment go in that time?
Well, I think unemployment probably edges slightly down. Not really far down, but probably slightly down. But that's also consistent upon actually accomplishing the policy outlook that I'm just giving you where my dots were, right? That also is reliant upon policy actually, sort of moving down. I worry that if policy stays this restrictive for that much longer, then the Fed itself will induce a slowdown in the economy because policy is so restrictive.
Are people right to raise the question about Fed independence right now?
I think that Fed independence is of critical importance.
Why?
Because you want to have policy decisions being made for the Congress assigned to the Fed the mandate of stable prices and maximum employment, right? You want to have policies being made for those purposes and not to manage to some political or electoral calendar, right? So you want to have those decisions insulated from the political cycle in Washington. So I think that's important. However, I also think that in order for the Fed to remain independent, it has to be seen as non-political. And that's why it's so important that we avoid mission creep from the core mandates that the Congress assigned to us into areas like climate change, into areas like entering the fray of highly charged racial politics. It is really important that the Fed not get involved in heavily politicized subjects that are outside of its core mandate, because if it does, it will cease to be viewed as non-political, and that independence becomes under threat. So I do think that independence is of critical importance, and I think that the Fed can and will do a much better job of maintaining that independence.
A lot of people see you and they say, oh, here's President Trump's guy from CEA coming into the Fed advocating for lower rates. That's an example of blurring the lines.
Well, I mean, first of all, presidents have long appointed former CEA chairmen and chairwomen to the Fed. Ben Bernanke was a former CEA chairman. Janet Yellen was a former CEA chairwoman. Alan Greenspan was a former CEA chairman. This is a practice that sort of long predates President Trump.
Right, and the only reason you didn't step down fully is because you don't want to have to get confirmed again.
I already went through the confirmation process twice. I wouldn't wish a single time on anyone. I have no desire to go through it a third time. And look, in the 1980s, in the Reagan administration, the confirmation process took 3 days. 3 days. Right? Now it's, well over 100.
Right.
And, if it was 3 days again, who cares? No big deal. Right? But it's a substantial pain, especially if it were sort of, in theory to be confirmed for the same job I was already confirmed for once. So,
Have you had any discussions with the president or the secretary or anyone about staying on past the Jan 31st?
I have not.
Role?
I do not make personnel decisions. I have not made personnel decisions other than people who advise me. I have not made any personnel decisions, and have no intention of getting involved in personnel decisions. I'm, as I said before, the Fed should stay in its lane. I also stay in my lane, which is economic analysis.
Should the president be allowed to fire Lisa Cook?
That is a question for lawyers, not a question for me.
But she says that if he is, it's an infringement on Fed independence.
So, this is not a subject that I really know much about, and I would encourage you to interview her about that.
She's not that interested.
Well, I'm here to talk about my economic views. It's not a subject I really know much about.
So the whole theme of the day is investing in America, and this is the grand finale, right? And we're talking about how the private sector has been, more active than we've seen, almost patriotic right now about putting money into America. Do you think that's in the economic forecasts? Is it in yours?
So, there is some substantial increase in investment into the United States in my economic forecast. And if you look at the speech that I made a few weeks ago at the Economic Club of New York, I talked about how there would be increased investment due to changes in tax and regulatory policy. I talked about how there was credit guarantees being given by some countries as part of the trade deals that had been negotiated with them. And I also talked about how FDI had been something else that had been elements of the trade deals. FDI I didn't really view as having material consequences for monetary policy because it tends to move the supply and demand of loanable funds by roughly the same amount, whereas the other two will just move the supply or the demand. And so I viewed them as more consequential for monetary policy.
Okay, really quickly. Do you care that gold is at a record high?
No, I care. I've been appointed into a role for which the Congress has told me focus on stable prices and maximum employment. And they didn't tell me focus on the value of gold. If that is the view of the Congress, I would encourage them to tell me that that's the view of the Congress, and then I will focus on the price of gold. But as long as they've given me things to care about, I'm going to follow the law. I'm going to do what they told me, which is focus on stable prices.
Well, yes, but it could say something about the uncertainty in the system.
Look, you might argue that there's some sort of geopolitical risk premium or something that's being embedded into the price of gold. I don't know that there's substantial economic consequences of that. I certainly don't see such a similar risk premium embedded into other asset markets. I don't think
stocks are at a record high.
Yeah, I don't look at the stock market and say, there's something here that I'm missing about geopolitics that I don't understand that's being included in the gold market. And also, we started this by talking about shifting geopolitical plates, right, and potentially shifting geopolitical dynamics and how that might affect the economic outlook. So I don't think that this is something that I'm ignoring, that I need to sort of look to the gold market for some sort of clue about what's going on. I think, frankly, given the activities that I was involved in my last job, I probably know a little bit more about it than some other folks. Again, if somebody were to sort of convincingly tell me that there's some signal about the economy that I'm missing from this, I'm very happy to hear the argument, but I haven't seen one.
Are you having more fun at the Fed or the Council of Economic Advisors?
Let me tell you, this is really sad. So when I saw the China rare earth announcement, of course, I started imagining what must be going on with my former colleagues and meetings that I had. You were
having like FOMO, trade war FOMO.
Oh, it's serious FOMO, and I was imagining all the meetings that must be happening and the plans that must, and what people were discussing or thinking about doing. And I spent the day, sort of discussing whether a small regional bank should be allowed to make some modest change to its loan offerings, thinking about this other stuff that was happening. So, yeah, I had severe FOMO for
So more fun in the other job?
Well, it waxes and wanes.
Now you guys get to say that the outlook has deteriorated.
Well, there's a risk to the outlook.
Right.
There's a new risk to the outlook the outlook has not yet materially deteriorated.
Okay.
However, there's a new risk to the outlook that did not exist a week ago. And that risk is here now in a way that wasn't true a week ago.
Right. I'm sure they would take your calls if you called your old team.
Well, you just spent some time talking.
We don't want to blur the
independence.
Yeah. Okay. So got it.
It's best that I let them do their thing and that I do my thing.
I agree. Stephen Miran, thank you very much.
Thank you.
Appreciate it.
Thanks.